All right. So if we look at, we can close this now. We look at go back to our spreadsheet, and we go back to the problem that we were discussing at the end of the last session, where we had asked people, Vipul had said that we were discussing the underlying positions. Now, what is the situation in the case? We have, this is the case. So we have this, let's give the name a nice little bit of bold type. All right. So the questions that we were discussing, key risk factors, we have already identified them. Then we are trying to understand the underlying positions, okay, with respect to each KRF market. What are the underlying positions? And this is just by way of a recap where we were. And we had already gone through the asset side, the underlying position on the asset side. And I want to just make it a different color so that we have. We know that these are not they almost look like the same, the assets, particular assets. So we have gone through the underlying position on the asset side. They're all on the longs. They're all long positions, okay? And on the liability side, we are trying to identify the underlying positions with respect to each of the KRF markets. So the KRF markets here are the dollar yen. You can call it the dollar yen spot market. Actually, the actual indexing will be to the separate forward rates when the loans are payable, when the loan installments are payable. But we will just discuss it as a spot rate, okay? So if we just discuss it here like this, if you go back to what we were discussing the other day, maybe you guys saw this, right? We had this, did I discuss this kind of a distribution of prices? Or we can discuss it here. Let's say, so actual, what are the actual exposures? Let's look at the actual exposures, which is something like this, okay? How did this happen, actually? How did this happen like this? Everything seems to have gone, the 3 month and all should have been here, but it's some other, maybe there's some shifting of the cells downward or something like that. Okay, let me just take this up here, and then let me just take this back up here, because it's supposed to be here, right? I think I must have shifted some cells down anyway. So the point here is that when you have let's look at this at 22nd Jan, the 22-1. So yeah, let's look at what we are looking at is we are looking at the dollar yen. Initially, we're looking at the dollar yen. The underlying position in the dollar yen KRF market, okay? But let's understand the actual KRFs in the case of, we would just call it dollar yen spot. And but the actual distribution, though, you have to learn how to do it. Okay, the actual distribution will have to be looked at this way. So here you've got a 5-year, what you've got is what is the dollar yen loan? The yen loan is an 8-year maturity and has a fixed rate of 275%. Okay. What we should also write here is we'll make it to make our life a little simpler, we'll make it annual coupons. So whenever you're looking at any kind of loan, any kind of loan structure, whenever you look at, you have to also be specific about, when you look at interest rate products, there are many things you have to clarify. If it's you need to know what the maturity, when somebody tells you this interest rate, that the interest rate is 5%. Okay, so you have to clarify many things. That statement doesn't mean anything. Say if somebody tells you that, you know what, I'm getting 5% on my deposit. Well, the statement doesn't really tell you much. You need to know which currency is it, because 5% in Australian dollars is not the same as 5% in yen, because the currencies are different. So you can't compare them. Depending on your home currency, if your home currency is US dollars, you'll have to convert both of those flows back into US dollars, and then only then can you compare them. So the first thing you have to ask is, you have to know what currency it is. The interest rate, when somebody just tells you I'm getting 5%, you have to identify the currency, you have to identify the maturity, then you have to identify the particular credit risk. Okay, since we are discussing this, let me just make this point also down, note this down here. These are these are discussed somewhere down the road in our notes, but we'll just write it down here. Okay, any interest rate. Okay. Okay, so example 5%. So it's not well. For full information, we also need to know currency. Which currency is it? We need to know. We need to know the maturity. Okay. So maturity I would refer to as, and this applies anywhere. Okay. So if you're discussing interest rates in India, you will obviously generally there will be Indian rupee rates. Okay. So, but the tenor you'll need to know. You'll have to clarify. Okay. Any interest rates, 5%, etc. Currency has to be known. The tenor has to be known. The issuing entity, and in particular its credit rating. Okay, so you have to understand there is something called there's something which we should also study in this. Let me just find out if we have that. Pressure. Yeah, there we are. That's what I was looking for. Corporate credit ratings, a quick guide. This is part of your material for this course. You can start studying it, those of you who have the time. And this is important knowledge actually, because in this particular course, International Financial Management, we are trying to study the problems that are faced by a corporate treasury. Okay, so there is this organization. This is a kind of organized. This is like a Chartered Accountants Association, a kind of thing. So this is a association of corporate treasurers. It's a UK-based body, and they have a very nice wiki actually. So on this page, on this wiki, you can learn a lot about the problems. There's a treasurer's handbook. You can learn a lot about the problems that are there in the case of corporate treasurers, what kind of problems they deal with. They have a certification as well. So there's a lot to learn here. This is an industry body. This is typical of how I approach the teaching of finance. It's not a very typically academic resource. It's not an academic textbook, but it's got a lot of information and it's got a lot of conceptual information. So I'm going to take this thing here and paste this into this here. So what did I say here? Issuing entity. And why are we interested in the name of the issuing entity? Or let's say plus credit rating. Okay. We want to know who issued this, who is paying this 5%. Is it the government of India? Is it the government of Japan? Because Japan's credit rating is higher than India's. Okay. So we also want to know the issuing entity. Okay. And we want to know the credit rating of the issuing entity. These two questions we will ask together. So here I've given you the link to this, and then you can see here, this is something here. You don't have to memorize this. Sorry, I clicked on it. I'll just go back. Okay, so you don't have to go back, but you don't have to memorize this stuff, but I'll just show you here. Yeah. So this is something that you need to be aware of, because some of you are going to apply for the care ratings interview. Okay, please make sure you find out from Faraz when the interview is. You have one of your seniors there, two of your seniors actually. there's a third one. The third one has already left care and gone uh, to Standard Chartered. So, but Manik sir also, you can talk to Manik sir, and obviously he will give you much better input on care ratings. Please make sure you're well prepared for the interview. Where are those ratings? Read all this stuff, okay? Read, and then if you have questions, you call me and we arrange a tutorial or something like that. But it's your response. I cannot spoon feed you. I can show you what you have to learn, and it's your job to practice and learn it yourself. Okay. So this is the stuff that we are talking about. What are we saying here? I'm saying that it's not enough for you to tell me that I'm getting 5% on my deposit or on my on some money I'm lending. I'm lending some money to somebody and I'm getting 5%. That information is not good enough. I need to know which currency, what tenor, who is the issuing entity. Okay, or in this case, let me make it more general and say, or issuing entity means debt issuing entity. Okay, so let me call this who is the borrower. Let's make it more general and more simpler. This issuing entity, normally we don't mention the word debt, but that's what it is meaning. Okay, so we want two things we want to know at once. We want to know who is the debt issuing entity. Is it the Republic of in the Kingdom of Denmark, or is the Kingdom of Saudi Arabia? They are the issuing and debt issuing entity, or the borrower who's going to be paying you this interest rate. And we also want to know what the credit rating is. And credit ratings, you should familiarize yourself with this. As you know, the care rating interview might be coming. So these are the major rating organizations. And then, of course, we have newer ones in India like CARE and all those people. So please get a sense. No need to memorize this stuff, but understand the basic structure of this. Investment grade means it's good quality credit. And non-investment grade, this is referred to as junk. Okay, this stuff is called junk rating. Okay, so India's rating is somewhere hanging around just above junk. Okay, so maybe I don't know, after this COVID thing, it might have fallen into junk. So these are poor quality credits, which means these are like it's like, think of it like Kingfisher Airlines before going into bankruptcy. That poor quality rating. That means highest, lowest. Highest means least likely to default, and lowest is most likely to default. Okay, so ITC, Hindustan Lever, these companies will be over here, tremendously cash rich. Procter and Gamble, Nestle, these kind of companies are all going to be over here. Microsoft, Apple, Netflix. Netflix gave out some very interesting information the other day. I don't know if Netflix is AAA, but Netflix apparently, I have to look at the announcement. Netflix is apparently saying that they are not going to need any more financing from anybody. They will finance the whole company through internal accruals. I need to look at that statement. It's a very interesting statement. So anyway, so these are top rated companies, and then you have the junk rated companies, okay? Poorly rated companies. So just get a sense of the overall feel of this thing, and then bookmark this thing, bookmark this link, okay? So if anybody wants to ask you, what is the rating after AA, you just say that I'm not that AA. You can ask Aman, but you don't have to memorize this stuff, okay? You say just, okay, let me call up my link and then I'll tell you what it is. Okay, you don't have to memorize this stuff, but you should just know the broad sequence and the broad structure of what's going on here. These are the three companies, and they all have different codes. Okay, so this is one job for you guys. Start familiarizing yourself with all this, and then in your credit rating in your care ratings interview, you can tell them that I have studied all these things. Okay, I have a sense of all this stuff. And another thing that I would tell you to do. One second, just hold on. Just give me a second, please. Yeah, sorry guys. Okay. So so this is one thing. Another thing you should also, okay, I think we'll leave that discussion for later. We will leave that other discussion for later. There is also a discussion about credit spreads, which we will talk about later. But the whole idea of credit ratings, the next idea here will be credit spreads. I don't think this is the right time to discuss that. What we are trying to discuss here is that whenever you talk about interest rate, you have to know all these other matters. Who is the debt issuing entity or the borrower? What is the credit rating? Let's look at what else do we need to know. Currency, maturity, issuer, and his credit rating. Okay, coupon. Okay, and you'll find a little bit of fixed or floating interest rates. You need to know that. Okay, what is the basis of the interest rate? Then coupon payment frequency. I'm writing the whole thing over here. Basically, you would just say annual coupon. So most of the bonds in the U.S. bond market, if you look at, most of them are semi-annual coupon payments. So if you have a 5% Kingdom of Denmark, U.S. dollar rate bond, that will be semi-annual usually. So every quarter you will every 6 months you'll get approximately 2.5%. Okay, interest rate that you'll get on that bond. Okay, so the rate is quoted on an annual basis, but you have to specify, the bond will specify whether the coupons will be paid semi-annually or quarterly or annually. These are the three most common conventions. And then there's also the matter of the interest. Since we are going through this topic, I want to give a comprehensive review of this topic. Interest calculation. We call this actually. Basis, which means example will be, let's put it this way. Actual 365, you'll get a little bit of information on this when you're looking at swaps in the Hull book. Okay, you will get some information on this, but the point here is that what is meant by actual 365, ACT 365. Then the other convention is other common 30 by 360. Okay, so on and so forth. Now, what does this mean? What it means is that I am going to use a certain interest calculation basis. I'm going to use a certain convention, okay? Because you're talking about paying a 5% coupon. Let's say annual is quite simple. There's not much of a problem. But even then, you have to calculate how much money is actually due. And so what this means, for instance, is that if I'm using actual 365. Okay, it doesn't matter, especially this becomes more relevant in the case of the semi-annual and quarterly payments, that we are always going to assume that the year has 365 days. Okay, although in a particular leap year it may be a different thing, but even the point is that even in a leap year, we're going to assume that the year has this many days. And the other one is that we're always going to hear this convention, we are going to always assume that the year has 360 days. Okay, so these are just interest conventions. So there's nothing special here, but the point is there's no major concept involved here, but except that that obviously you need to know an interest calculation basis, because how will you do the conversion? If you have a 5% coupon rate, the rates are always quoted on an annual basis. And suppose this was semi-annual. Okay, suppose this was semi-annual. How would you calculate the actual number of days? Because the amount of money that is paid is principal times the actual coupon, but then prorated to the interest-free period, the accrual period. If it's a half year, then half year, how do you calculate the total number of days? And what fraction do you use to actually determine the amount of money that is paid, the effective interest rate for that period? So for that, you need some conventions about this, like what is the numerator, what is the denominator, Okay, what do you assume in the denominator? So these are the things that apply over there. Okay, so this interest calculation basis also needs to be spelled out. Okay, so now when you have all this, I think pretty much we've got all this. I'm just doing this from memory here. I think we have pretty much got everything. Okay. Yeah, so this takes care of it. So the point I'm trying to emphasize here is that it's just a simple thing like an interest rate that also requires many, many other things to be specified in order for it to be completely meaningful. Okay, so don't just think this is just an interest rate. There's more, everything is quite deep actually. So this just okay. Now, what were we actually talking about in terms? We were talking about the dollar yen exposure. We were trying to figure out the dollar yen exposure. And I'm just trying to show you how you should think about this when you actually have to manage this stuff for a treasury. What you're going to do is that, let's say we have about, what is the interest rate here? 5%? No, the yen is 2.75, okay? And we have roughly about, say, 2.85 we can take this figure from here, okay, and put it here. Shape special, base special. Okay, this is our yen principle. Okay. All right. So what you have to lay down is I copied this and I forgot about this. Okay. So let's take this. Let's say so. So what you have to lay out is that here you have to pay, and this 3 months. Let's say we are paying annually here. Okay. So we are paying annually. So it's the annual coupon. Okay. So interest rate of 2.75%, 8-year maturity. So you have to lay it out like this. Okay, years. So it'll be 1, 2, 3. Good. Okay. So 1, 2, 3, 4. Learning how to count. Okay. Let's take this to the center and let's merge the cells so it looks nice. Okay. Right. Okay. So we got this. Now what you have to do is you have to see how much is going out in 1 year. Okay. So in the first year, we assume that bullet repayment of principal. So in the first year, this will be basically, what is it? 2.75. So we put the coupon here. All right. And we have, so we can actually just put this because it's annual, it becomes very simple. So we take this to this, okay? And we will just take this as, so into 2.75%, the amount of yen. All right. All right. So you have this, and then basically what you have therefore is to D. What do we need? We need to lock down D, and 84 will be automatic. Where is $D? Yeah, $D 84. All right, so we'll have this and have this as well. Okay, so this is what you need. Okay, and here, of course, this will be this, and the last one will be this. right, so this is the P plus I. Okay, towards the end you have the P plus I. What font do we have here? We'll make it 10, so it's a little smaller. And it can fit here, and we can give it some nice formatting. Fine. Okay, we can make it 11. All right, now you see this. All right, so when you're managing risk on a yen loan or any other loan, this is how you have to set it up. Okay, you have to look at the principal, you have to look at the loan repayment schedule. So this is what we have done here. Okay, maybe I need not have done all this, but at least it, maybe just refreshes your, just runs you through the process. You have to lay it out like this as a repayment schedule. So these are all payments, so these are all minus. Normally the convention that we follow in finance is we draw a timeline. Okay, so if you wanted to visually, I've shown you this on a spreadsheet with the actual numbers. If I wanted to just visually show this, I would have this as a timeline. Okay, so you should learn this convention also. Okay, when I'm showing this, a lot of the derivative structuring language is like this, where people are communicating with each other and derivative structuring teams, etc. The convention is we show a timeline when we are trying to show the cash flows. We show a timeline, and if there is an outflow, we show it as a minus, it's a down arrow. So there'll be an arrow like this and arrowhead, arrow going down. Okay, so you can actually do that on Google, on Sheets itself, I think. Okay, if you have, I think you can get, but anyway, we will not bother with that right now. But you can show it down. So what we do is we draw a line, timeline, mark it with years or months or whatever. And then if it's a positive cash flow, we show it as an up arrow. And it's a negative cash flow. So these will all be shown as negative cash flows, okay? So actually what you have is, you have a short position in yen, okay? Because you have to pay these amounts, okay? And if the yen value goes up, if the value of the yen rises, you will, because your liability is in yen. So this is where we are getting into the discussion of the question that we asked, which Vipul had answered initially yesterday, the other day, and then we ended the class. So I'm getting into that. So what we're talking about is, here. So these are your liabilities. So what you see here is when you lay out the position here, if you wanted to do it in the form of a diagram, you would do a timeline, and positive cash flows will be shown as up arrows, one going up like this, arrowhead. Here you would show all of these as down arrows, down like this, and then arrowhead. Okay, so you are, yes, Ketan? Yeah, Ketan, you raised your hand.
Sir, by mistake it was there.
Okay, no problem. Okay, so this you have, so you show this as a down arrow. Remember that convention also, okay? I'm not writing it down anywhere. These are the things, I can't write down everything, it will slow me down. So that's why you have the video, you can refer to it. So remember, it's very important convention for derivatives payments, showing derivatives payments on the timeline. Draw the timeline, positive cash flows up arrow, negative cash flows down arrow. Here I'm showing you the numbers. So what you actually have is a whole bunch of short positions in yen, okay, distributed like this. Now it's very important to also start fine-tuning your view of the position. When you have positions in multiple maturities, you should be able to lay it out like this, okay? Whether you want to do it by column or by row is a different, whether by column or by row, you want to do it by row, it's a different matter. But because, for instance, here I've done it by row. Here I've done it by row. You notice here I've done the layout by row. How much oil India needs to buy in each of these, periods. These also should have been shown as, if I'm showing it as India needs to buy this oil, these should also be shown as minus, with a minus sign, okay? Because we need to buy this, so we have short positions, okay? So, but I think initially I showed it for the case of the oil company for Saudi Aramco, so I had them as positives. So you lay out your position like this. So what you have is a whole bunch of short positions in the yen, okay, distributed across the timeline like this. This is what you have. This is your position, okay? Now, what you have from here, so this is how you should understand it. But what we say, therefore, what you have is a whole bunch of forward rates. You have a whole bunch of forward positions. Remember, these are all forward positions because they are not spot, they're not futures or anything. These are loan repayments that you have to make. So these are all forward positions in terms of the instruments that we have. These are all forward position because the maturity is T plus 2, greater than T plus 2. Okay, and much, much greater actually. So this is forward. I'll give you just an idea about the Netanya rates. We have forward rates. We should understand them. We don't have time right now to get into how the forward rates are quoted and calculated, but we should understand that here's where you understand forward rates. Okay, so let's put a rate for FX forwards, link for FX forwards, and put it here. All right, FX forward rates. I'll show you this. First, let me put the link, and then I'll bring it to your side. US dollar forwards. That's right. Okay. Copy and Control K. All right. Okay, that's what we want. Okay, so now I'll bring this forward to you, and I'll show you this thing. Okay, so these are your forward rates. This is how a forward rate table looks when you're looking at market displays. When you're looking at a Reuters screen or a Bloomberg terminal, if you're working in a trading room or even in a corporate treasury. Corporate treasuries also need to look at dollar forward rates because they need to be hedging. If you remember in your hull book, there is actually an example of a British pound forward transaction where there are several forward maturities shown: 3 months, 6 months, 9 months. Where do those rates come from? You'll see there's a whole bunch of rates that are shown. Those are called outright rates actually, and these rates are derived from when you look at the dollar forwards market. Okay, if you go into a trading room and say, okay, let me show you the forward prices, the FX forward prices, they will show you something like this. Okay, it may run longer than 1 year, and there may be more maturities. Okay, so there may be a 9-month, also there may be a 4-month, 5-month price, but this is what it looks like. Okay, if you just forget the bid and ask spread, let's look at only the bid side. Okay, so you have a whole bunch of prices. You'll notice that the prices are different. Let's look at the position that we have dollar yen. Okay, so these are what these signs are. Why are they minus and some are plus, some are minus? That we won't go into right now. But the basic point that you have to understand is there are these US forward, prices that are quoted, FX forward prices that are quoted, FX forward basically swap points for FX forward transactions. These are called swap points, right? So let me call it here, FX forward. These are actually known as FX. So you learn the lingo as well, okay? FX swap points. These are called FX swap points. What happens here? Still have the hyperlink? No. Yeah, you still have the hyperlink. That's fine. Okay. So these forward rates, we call it FX forward rates, but these are in the lingo of the market lingo. These are called FX forward swap point, FX swap points for the various forward maturities. So the way the forward rates are going to be derived are going to be adjusting. You will take the spot rate, which you will find here. If you click on majors, you will find the spot rates. So I'm just giving you at this point, if everything does not seem 100% clear to you, that's okay. I'm just giving you a feel for how the foreign exchange forward market works. Because again, this is something unique about the way finance is taught here. We don't just teach you equities and bonds. because you should understand general principles, and you should be familiar with all the major markets. So we teach you FX markets as well, the most important market in the world. I mean, the biggest market, the most liquid market in the world. So you should have comfort level with FX markets as well. So this is what it is. I'm just giving you a brief flavor for it, so you remember the key words. These are called FX swap points, and then what we do is those rates that you saw on your Hull book, those rates are derived from the application of the spot to the you adjust the spot by applying the swap points, which are here. So you take the spot rate, which is say 103.55 roughly, 103.55. I was looking for the example in the Hull book, so I got a little distracted. So you take the spot rate here. This is how the forward rates come out. You take the spot rate here, and you go to the forwards page. What happened? Yeah. And so if you want to know the dollar yen forward for say 1 week, you subtract basically 0.75 of a point. Okay, so this actual how it's done, we'll discuss it later, but you adjust the spot rate by using these different swap points. These are FX swap points. You notice they're all different for different maturities. Okay, the prices are all different. The swap points are all different for different maturities. And then by adjusting the spot rate by this point, these differences, these are swap points, the spot swap differences, then you can get the actual applicable forward rate for this maturity. So what you have to do conceptually is you lay out your actual payables over here. You have to lay out your actual payables here. You look at the spot rate. Okay, you put the spot rate somewhere, and then you apply ideally you set up some kind of data feed which allows you to calculate the forward rates, okay, for each maturity. And then you set up basically what you have is a bunch of yen liabilities, because these you have to pay. So you have short positions in yen. And because remember, your revenues are in dollars. What does it say? Your revenues are in dollars. Okay. So you have a bunch of short positions in yen, and you have a bunch of assets or long positions in US dollars, because that's where you earn your revenue. Okay. So, and then you will see what the applicable interest rates are also, the applicable foreign exchange rates are for each maturity. Okay, here you don't have 8 years of rates, but you can find it out from the market, from the dealers. You can find out the forward rates for 8 years. Okay, so this is how you would do it. This is how you would lay out the exposure. So when you lay it out like this is a different way to understand remember this whole discussion is happening in the context of this question. What is the underlying position? Okay, so the logic that Vipul applied was that he was applying the general logic which I've taught you, which is not wrong, which is the correct logic. But as we applied that logic, we saw that his initial answer was not correct. Okay, but obviously there's nothing to be ashamed of. At least he was able to quickly answer and come out with a strong view. That is also very important. So he was applying the logic that if the market drops, they will make money, and if the market rises, then they will lose money. And then he saw that based applying that logic, it seemed to him that the logic therefore it would be a short position in dollar yen. Okay, but as we saw, this is not true. If you see what happens, look at the net worth figure, 2.37. I'm going to change this. I'm going to make a dramatic change. I'll change it to 100 from 109.44. What happens to my net worth? 2.1. Okay, so my net worth drops. Okay, all else ceteris paribus, as you remember from your economics classes, ceteris paribus, other things remaining the same. Okay, then everything starts moving together, which is how the real world works. You really don't know what will be the impact on net worth. So all your sensitivity analysis, everything is done by either applying explicitly or implicitly a ceteris paribus assumption. That is that all other factors remain the same, because net worth is affected by so many other factors. Okay, so we can see here one thing is that when the dollar yen drops, remember here your exposure is to the dollar yen. So when the dollar yen drops, this is the market, there's a dollar yen market. where dollar is the base currency and the price is quoted this way. When the dollar yen drops, it's yes, double A.
Sir, if in case of AUD dollar and USD dollar, it will be short.
Yeah, we'll come to that. We'll come to that. I'm first explaining the logic for this. Okay. So what we see here is that here when the dollar yen drops. So remember, your exposure is to the dollar yen. We try to open the. Let this load. It will take some time. So your exposure is to the dollar yen, because the prices are quoted like this. So you have to know, based on this, what is the market with which you are concerned. It is not the yen dollar market, it is the dollar yen market. You're talking about the spot market. You have expressed your exposure in terms of the spot market. You're assessing your exposure you're analyzing your exposure in terms of the spot foreign exchange markets, where the dollar is quoted as dollar is the base currency, yen is the terms currency. So it's a dollar yen market, and the question therefore is, with the KRF market as the dollar yen market, you can either take it as a spot market exposure, and that's what we usually do, because as I told you, a whole bunch of forward rates will be okay. So we can talk about the FX spot, which is spot and forward. Okay, so spot will be whatever that spot rate was. I think it's 103.50 or something like that. Whatever the spot rate was, figure out the spot rate, and dollar yen spot is 103.55. Okay, so we write this as 103.55, and then we have to find out the spot. We need to find out what is the forward rate. We need to find out the FX swap point for 1 year, FX swap point for 2 years, 3 years, 4 years, etc., etc. Find it out from the market, then adjust the spot rate by the swap point. That will give you the forward rate for that maturity. And A, B, C, D, E, 1, 2, 3, 4, 5, 6. You get a whole bunch of 8 forward rates. Okay, and so you can convert these liabilities that you have, fixed liabilities on your loan repayment schedule. The dollar value of that liability can be expressed by converting these liabilities into using the applicable forward rate. So you do not show the 5-year forward liability like this of this amount. You do not show the dollar amount of that. Okay, the forward rates, we put the spot. This is already spot is there. The forward rates will be here. Okay, FX forward rates. Let me just show you this whole framework. Okay, so you have to learn this framework. And although in practice, what we will do for this project, it's just to make your life simple. You need to know how it is done in the real world. Okay, the exact approach. But here, what we are going to do is we are going to simplify it, and we are just going to hedge in the spot. Okay, so in fact, in real life also, many times you may do that. Okay, that's why we are going to do it, but you have to understand what your exact exposures are. Your exact exposures are actually a whole bunch of 8 exposures. You have 8 exposures. You have 8 short positions in dollar yen. Okay, sorry, 8 short positions in yen. Okay, you have 8 short positions in yen, because each of them is for a different maturity. And what you're going to do in practice, of course, is because it's not practical to manage it like this, and the differences, these prices move a lot more. The spot rate moves a lot more than this stuff. We go to the forwards again. So the forward rate is a function of the spot rate adjusted by the FX swap point for that maturity, this maturity, this maturity. Now these FX swap points, they don't move that much. Okay, they don't move around that much. These are a function of interest rate differentials. They don't move that much. So what we can do effectively is, for practical purposes, although we should know theoretically that we have a bunch of 8, we have 8 specific short positions in the yen corresponding to 8 different maturities, and each of them, the dollar value of that has to be calculated by applying the particular forward FX forward rate that applies to that maturity, which is to be calculated by taking the spot looking up the FX swap point for that maturity, and then adjusting the spot rate by the swap points to arrive at the forward rate for that maturity. Okay, this is the logic you have to follow. When you should know the theory, okay, how to do it exactly if you want to do it perfectly. But in practice, as we said, because the swap points do not move that much, what we are going to do is we are going to lump up all this stuff. Okay, we're going to lump up all this stuff and show it as you sum all this, basically you sum all this and show it as a liability, and that you manage on the spot. So you sum up all this without doing time value of money or anything. Usually we don't apply that much fineness. You can do that if you want. You can take the present value, because the yen payable is 8 years later this much. So the present value of the yen payable, you can apply that, but actually then you'll have to adjust your hedge more. And because anyway, eventually you have to pay this amount, and that's what you're hedging for. So in hedging, we don't apply this present value for, framework for our hedging program. Okay, so we just sum it, and let's see what we can sum here. We sum this. All right, so we write this here. So that's what we have, okay? And so here what you can write is, that means this is your total short position in yen, okay? And you have, obviously this is 381,250. You see it's a little different from this, okay? It's showing 312,500, okay? What is the difference due to? Why is this bigger than this? Because we have captured the interest payables also, right? So your liability on the yen loan is not just the principal; it's also the interest payments. These interest payments are also going to be in yen. Okay, so every year you have this amount of yen to be paid as interest on the loan. Now, where are you going to pay yen from? You don't have any yen. You earn only in US dollars. So you have a bunch of yen liabilities on account of interest payment, and then at P plus I, at the bullet repayment, end of the loan, P plus I, you have P plus, you have I plus P. So that's why your 381 is bigger than the 312, because this is the sum of, without doing present value, this is the sum of, this is the actual sum of the all the interest flows. Is everyone clear? Are you all following so far? Yes?
Yes, sir.
Yes, sir.
Okay, good. Okay, so we are here, what we are showing you is basically, this is how the whole logic works. So you have to understand what are the, if you want to be very, very specific, what are your actual positions? Well, on account of this loan, you have, on account of this loan that's sitting on your book, and the nature of, and the characteristics of that loan, where we know that, where you have told us that the loan has, you told us that the loan has an 8-year maturity, the 2.75% annual coupons, okay? You told us all this, and so based on that, we can figure out that these are my liabilities. So I have to figure out, actually I have to pin it down to the last point of what are my actual positions in what currency. Am I long and short? Am I long or short, and in which currency? So here I find I'm short yen for these various, and which settlement date am I short for? Which maturity am I short for? Okay. Here I'm short for 5 years, here I'm short for 7 years. Okay, so, and here this is an oversimplification because it is not sufficiently granular. It does not tell you how much of this is short for 2 years, how much of this is short for at the 3-year point, how much is short at the 5-year point. But this is a like a shorthand back of the envelope, because in order to manage my hedge, in order to manage my hedging program, I'm going to just lump it all together and manage it as a spot position. Okay, so this is how you're going to operate. And so what you got here is, this is the yen amount, okay, and so you need to look at the dollar yen. You should also look at the dollar value of this. Okay, so you've got to have the dollar value of this is this, your dollar position will be long dollars. This divided by, we'll have to basically put it this way. Let's put it this way. The dollar position is, okay, this is also something to think about, okay? Should we multiply or should we divide if I want to express the dollar amount?
Right.
Okay, yeah. So remember, if you ever get confused, what do you do in the case of rupees? And dollar yen is no different from dollar rupee because both cases dollar is the base currency. If you ever get confused, what will you do if you get like 40 lakh Indian rupees and you want to know the dollar value? You don't multiply it by 76, you divide it by 76, okay? So here we are going to divide it by this, and we want to show the dollar position. So we want to therefore, right, so this is what we have, 3.6 billion dollars. Okay, we want to, so it is 3.6 million actually, about 3.7 million dollars. Okay, so this is your long position. Okay, so another way of figuring out, now coming full circle in a very long discussion, but these are important because it's not so much, I'm not concerned with covering a whole lot of ground, okay, because one of the problems we have found year after year with all the batches, and your batch is actually one of the better ones because I find that a lot of students is, at least in finance, there are quite a number of students who are actually quite interested in this, in learning more about the subject. So you're applying yourselves, that's good. But still there is a problem that I find in the exams, okay, and we are going to discuss the exam paper also at some point. We'll have a tutorial session for that. And I'm finding that the concepts are still not clear. So that's why I keep on emphasizing you have to pay attention. I'm not here to, show some magic tricks and show you videos and play some music and make your life interesting. You should already be interested in finance and you have to know this stuff. So your duty is to listen carefully, and if you don't understand anything, you have to ask a question. Okay, and you have to make sure that you understand all the concepts that I'm teaching you here. So that so our goal is to make sure that whatever we cover, I don't care how much, we don't have to cover 150 concepts. Even if we cover 80 concepts, I'm fine. But those 80 concepts should be rock solid in your brain, which means you will never forget them in your life. Concepts are never forgotten, okay? Numbers are forgotten, but concepts are never forgotten. Once you learn it, it's like driving or swimming, okay, or cycling. You don't forget it. So you have to make sure that's your goal, because and that is basically what will be valued in industry, and it'll help you in your actual work. Okay, so coming long story short, what were we saying? When did I get into this lecture? I went into this lecture here. Okay, never mind. So what we are showing you is how you have to approach this. Okay, bunch of short positions, and you convert this into a dollar amount. You find that you're long. So roundabout way of figuring out, because our original question was, what was our original question? Is what is, we are looking at the key risk factor, which is the dollar yen market, the spot dollar yen market. And what is my question is, what is my underlying position in the spot dollar yen market? And so Vipul was saying it is short, because if it goes down, so one way to test is to do the numbers and see, and we can see here that if it went down, if the dollar yen rate drops, we are actually losing money. And here, if we go back and do Control Z, and so we are going to raise the dollar yen rate from 100 to 109. What happens to net worth? Net worth goes up. As the dollar yen rises, the net worth goes up. Okay, so which means actually this is behaving like a long position. This is behaving like a long position because as the dollar yen rises, now we're going to get this, no ads on any chart. Okay. It's not responding actually. USD JPY. Right, so as the dollar yen rises, we make money. As the dollar yen falls, we lose money. Therefore, we must be long dollar yen. Okay, this is one way of doing it. This is one logic. And there is another logic, which is to understand what is this thing that is shown on your balance sheet. What is this thing? This is a yen loan. Okay, what does that mean? You've taken the loan, so you have to repay it. every loan will come with a repayment schedule. So anyone who has taken a student loan or a housing loan knows that it comes with a repayment schedule. Okay, so you lay out the repayment schedule like this. Okay, year by year, period by period, and so your repayment schedule basically shows you what you have to pay. If you have to pay these amounts, that means you're short these amounts. So you are short the yen for these various maturities in these amounts. Okay, so it straight away tells you another way of coming to the answer that Vipul had given is to ask yourself, okay, what is the nature of this exposure? It's a loan, so that means I have payables and a repayment schedule. And if I have to repay this money, that means I'm short. And what will I repay with? Remember, our revenues are all in US dollars. Okay, so these are our business revenues, sales revenues, and those are the assets with which we can repay this money. So therefore, I am short yen for all these maturities, and I am long dollars because my business is a going concern. So I will keep on operating my business. I will keep on earning my revenues in US dollars. So every period I will have positive inflows of US dollars from my sales revenue. Okay, and that will be used partly to pay these loan liabilities. So what are my positions? A whole bunch of 8 positions in forward maturities, all in dollar yen. And what is the nature of that position? Those positions are short yen and long dollars. Okay, so you add them up, and just for simplicity, you display them here. That the long dollar position of 3.7 million approximately. Okay, is this clear? So there's another way to understand from the nature of the transaction without doing that mechanical calculation, and that can be your cross check. The mechanical calculation can be a cross check. Okay, this is another way of looking at it. It is probably easier to understand this, okay, from this point of view, and it's also important to understand from the way that I discussed it just now. Okay, because it shows you how to manage the actual risk and how to visualize the risk. Okay, and then you guys are doing, you can combine all this knowledge with the stuff you learn in IT, in analytics, when you're doing Tableau and all these software, the visualization software. You can show it in fancy ways, how to show the liabilities, etc. So you can combine all that there. Okay, but make sure that concepts are clear first. Software and all is just a way of doing it and to save you time and stuff like that. But your concepts have to be clear first. Right. So that's a yen loan. Okay. So we got the yen loan. Now everybody should be clear. The position is short yen and long dollars. You can see it from here itself. Okay. And you saw the numerical exercise which we did. Position is short yen and long dollars. And therefore, in this market, we say your underlying position in the dollar yen KRF market is long. Your underlying position is long because you're long the base asset, long dollars, and short the terms asset yen. Okay. Now coming to the second point, AA has already got an answer for us. Okay. And AA's answer was short. Okay. Is that right, AA? You were saying short.
Yes, sir.
Second question is Aussie loan, we are short. Okay, now you can see straight away without having to do the number, you can see that AA's answer is correct. Why? Because if you lay out, if you do the same thing, I'm not going to do that because it's going to take us a lot of time. We are going to the same thing. What is this yen? The nature of the Aussie loan and the yen loan are not substantively different. They are both loans. They just happen to be in different currencies, and they happen to be in different maturities and different interest rates. But the basic nature of the entry is both are loans, okay, loans payable, long-term loans or long-term liabilities, a part of the outside liabilities. So both are loans, which means if you do the same exercise, I'm not going to repeat it, but you can do it yourself for your own practice and try your fancy whatever tricks you've learned in software, your fancy formatting tricks. Okay, this is something we found even in, I remember even in Ahmedabad when we used to make our presentations, people used to spend a lot of time on all the that time the stuff was just coming out, Lotus Notes and all this stuff. We didn't even have Excel. And people used to spend so much time on these fancy formatting tricks. Okay, so you have to please make sure that your main emphasis is on understanding the concept. Fancy formatting gimmicks and all, it's good fun, but don't make that your whole presentation. There must be some substance. Okay, so all right. So what you do is same thing that you did in the yen. You know that it's an Aussie loan, so there will be a whole bunch of Aussie interest. Yes, Bhavya, you are not on mute. I'm going to mute you here. Okay. So you have a whole bunch of Aussie repayments, which will show as short Aussie positions for the interest coupon, Aussie coupon amounts. Okay, so you take the principal, apply the Aussie interest rate, have it out for 10 years, and show all the short Aussie positions. Okay, and so you can see the Aussie positions will be short, and the dollar positions will be long because you're earning money, you're going concern, your business will continue, revenues are in US dollars. What do you have to pay those Aussie liabilities with? You have all US dollar revenues. Those are your assets. Okay. So another thing to remember is assets. You are long the assets. Another way of thinking about it, you're long the assets and you're short the liabilities. Whatever you have to pay, you are short. Whatever you own, okay, or whatever you have to receive, okay. If Vipul owes me $10 million, I have accounts receivable on my balance sheet written as loan due from Vipul. Okay, trade payable due from trade receivable due from Vipul, $10 million. So that will be my asset, and that I'm long. So in that case, I'm long that much amount of dollars. Okay, so that is what I show. So that you have to understand. Assets you're long, liabilities you're short. Okay, whatever you are due to receive, you're long. Whatever you have to pay, you're short. So here again, you see in this case that AA statement is correct because he has correctly identified that Aussie dollars you're short and US dollars you're long. And what is the nature of this market? If you look at the nature of this market, when we trade Aussie US, what is the base currency? In Aussie US, what is the base currency? Yes, Shaurya, what is the base currency in Aussie US in this market? What happened? Shaurya is sleeping.
Pardon, sir, can you repeat the question?
Yeah, I'm saying that AA has just told us that with respect, because we are going through this exercise of going through all the KRF markets and asking ourselves, what is the underlying position in each of the KRF markets? These three we found were long. This one we found after a lot of analysis that this is actually long. In this market, we are long. Because what is this market? This is the dollar yen market, where the dollar is the base currency and the yen is the terms currency. This is how the price is quoted. So the KRF market here is the dollar yen market. With respect, now we come to the Aussie exposure, and the KRF market here is the Aussie market, spot Aussie. Okay, in the foreign exchange markets, we will just say we don't say Aussie US, we just say spot Aussie, and because the dollar is the most actively traded currency, it is understood spot Kiwi, spot Aussie, spot Swiss, spot cable. Okay, spot cable is cable. All of these are quoted against the US dollar. Okay. In some cases, the dollar is the base currency. In some cases, the dollar is the terms currency. This is a matter of convention. But now, my question to you is: in the Aussie, in this case, the KRF market is spot Aussie, which you can see the chart here. You can see the chart for that here. In this market, my question to you is: what is the base currency?
What is the base currency, sir? US dollars is the base currency.
Okay. Yes, Vipul.
Australian dollar.
Australian dollar is the base currency. Okay, so Shaurya, you have to understand that in this case it cannot be US dollars because what did I teach you? Look at the nature, look at how the price is quoted. Aussie US, okay, AUD US. Remember what I taught you? I think I taught you guys this.
Yes, sir.
Convention in this case, you have to understand this. The convention in this case is in the currency market, the base currency is always applied first, and then the terms currency that's written first, and the terms currency is written. Dollar rupee, you remember dollar rupee, the I rupee.
Yes, sir.
If you forget this, if you ever forget, and not just for Shaurya but for everybody, if you ever forget what the convention is, go back to the dollar rupee. I don't know if they have the dollar rupee here. Yeah, there you go. Okay, this everybody knows. Okay, If you ever forget what is the base currency, here you know what is the terms currency. You know that whatever price they're quoting, these are the forward rates, so that's why they're different. But if we go back to the spot rates, dollar rupee, you know that whatever rate, 76, 75, whatever it is the rate which is the number of rupees required to buy $1, right? You know that. So here's how you work it out backwards. You know that dollar rupee is the number of rates. What happened here now? Okay. You know that, what happened? Now I can't see. In the majors now, they're not showing dollar rupee. Anyway, never mind. You know that dollar rupee rate, okay? So you know that the dollar rupee rate is shown as USD INR. It is written as USD INR. USD is written first. And you know that the rate is for number of rupees. The fluctuation is basically in how many rupees that are required to buy. So therefore, you know that in the dollar rupee market, the base currency is US dollars. Are you following, Shaurya?
Yes, sir.
And by similar logic, you work out if dollar rupee, the base currency is US dollars and it is written as USD INR, then in the case of the Aussie market, where spot Aussie, which is written as Aussie USD, that means then Aussie must be the base currency.
Aussie is the base currency. Base asset. Yes, sir.
How to remember it?
Yes, sir.
Always work it backward from or dollar rupee, which you will always remember. Okay. And
Yes, sir.
not just for Shaurya, but I'm sure many other people also may not have been clear. So it is actually the base currency in the Aussie spot Aussie market is the base currency is going to be Aussie dollars, okay, Australian dollars. And so by convention, you should also know that also the Kiwi Kiwi also trades like that, where the Kiwi is the base currency, okay. So okay. So let's go back to this. So is double A right? Double A is right. He said the exposure, he said the underlying position in this KRF market is short. Why is he right? Because this is the Aussie loan. So if you lay it out, the cash flows, it will all show, assuming now, let's assume these are all Aussie flows, okay? It will look like this. You will have a bunch of Aussie payables because of the interest amounts. And then you'll have a P plus I payable at the end of the loan. And these are all Aussies that you have to pay. So that, therefore, these are your liabilities. Therefore, you're short these Aussie amounts. And your revenue is US dollars, so you're long the US dollar amounts for the corresponding maturities. So the positions are short Aussie, long US. And in this market is quoted with Aussie as the base currency. Okay, so the short and long position when we talk about is always with respect to the base asset. Here we say we are long copper. Why? Because in this market, copper is the base asset and US dollars is the terms asset. Because remember, every market is going to have two assets. All right. So therefore, here a double A is right because our positions are short Aussie and long US, and the market that we are considering has Aussie as the base currency. So you're short the base currency, which means you're short this market. Is this clear now to everybody? Now, yes? Okay. Now let's check. Let's confirm that double A is right. So let's reduce. Now we have got net worth is 2.3, 2.38, 2.37. Okay. And so basically 2.4. And now let's make this. So we are short. We are supposed to be short. So if we dramatically raise the price, we should lose money. So I'm going to raise it to 95. See what happens to net worth from 2.37. Yeah, you can see net worth goes down, okay, to 1.7. So double A must be right. And now we can go back from 95. We can see the other effect. From 95, we are going to drop the rate to whatever it was earlier. And net worth right now is 1.74. We are dropping it from 95 to 670. And the net worth goes from 1.7 to 2.34. Okay, so the net worth goes up. So what is the behavior of this position? It is when the market rises, it loses money. When the market drops, it makes money. Therefore, it must be a short position because only a short position will behave like this. Is this clear? So we have figured out the position from two different angles. One is by understanding the nature of the transaction, laying out the cash flows that represent the transaction. And the other is by applying this mechanical logic that we have, whether we make money or lose money, and then applying the logic of the nature, what kind of position behaves like this. Okay, is this clear? So we are proceeding slowly, but it's very important that you understand I'm deliberately going slowly and making sure, but we are also covering a lot of contextual information along the way. These are all things you need to know. That I needed to give you that warning about the upcoming interview. Also remember, those of you who are interested, please ask Manik sir, because he will be plugged into, although he's no longer there, but I'm sure he has sources. So check with Manik sir, check with Faraz also when those interviews are happening. Start preparing. I don't want to see a situation. Are you guys familiar with, anybody here knows what happened to ILFS? Yes? Anybody knows? Infrastructure, they used to be called Infrastructure Leasing and Financial Services, but then later on, like National Stock Exchange became just NSE. Chicago Mercantile Exchange became only CME Group. They also became ILFS. Okay. Now, what happened? Anybody remembers what happened to ILFS? Anyone in the class? Nobody? Nobody remembers. Sambhavna? You never heard of ILFS? Yes.
Sir, it went to bankrupt.
Yes, sir, they were unable to meet the commercial papers they shot. They were unable to repay the commercial papers.
Okay. And before that bankrupt, that was Saurya was saying, right? Who was
Oh, sir, Krishnandan.
Sorry?
Krishnandan, sir. Yes, sir.
Okay. Yeah. So so basically that is correct. So that you at least you have a nature of the problem down. Okay, and you have the nature of the problem down as to what was going on. So there was a bankruptcy. Okay, so this was basically, again, this was a very highly leveraged group. In most bankruptcies, you will see the problem is usually the same. They have put on too much debt. Okay, like what happened to Kingfisher Airlines and what Reliance, this Anil Ambani group also, whatever that is called, at ADAG, Anil Dhirubhai Ambani group, the Reliance Communications group, that side, they also had a lot of problems because they put on a lot of debt and they were not able to, the business was not doing well, so not generating enough operating revenues to cover the debt payments. So you would have heard of ratios, financial ratios, debt service coverage ratio, remember all that, DSCR? Yes, guys, remember it or not?
Yes, sir.
Yeah.
Yes, sir.
Please make sure you can do all this stuff with your eyes closed, like you're doing WhatsApp or something. Okay, I'm surprised to see that only 2 students have some clue about what went on in the case of ILFS. This is the problem that I was talking about earlier. Okay, that although from that batch, Deena got selected. Deena Arora is, I think, 2 batches your senior, 1 batch senior to I forget his name now. Chug. Okay, 1 batch senior to Chug. Chug is 1 batch your senior, right?
Pratik.
Yeah. And so Deena got selected, but the 18 students were interviewed by KR Ratings and only 1 got selected. Why? I mean, maybe lots of whys. But one of the things was before the evening before the interview, when I met the gang of students chatting around, and I asked them, at that time ILFS had just happened. I asked them, do you know what is going on with ILFS? You're going for a credit rating interview, and nobody had heard about ILFS. Just imagine. And I'm a teacher. I don't have to do that. I'm not going for a job interview. And the students are going for job interviews and they don't know all this latest news that is going on in that market. And I have already told you guys when you come in, I tell you how to track business news. So you have to get more plugged into what's going on in the world of business, okay? When you go for a credit rating interview, you should have covered all this, read all the credit ratings note, get a feel of things, look at credit spread charts. You should go to an interview. This is a slightly different kind of discussion. I'm not talking about finance here, but the whole idea is to, basically, I have to cover all these things as well, right? Make sure you guys are on your toes. So your goal at an interview has to be that when you go for an interview, you should blow them away with your knowledge of the subject. Okay, so if you're going for an interview with Marriott Hotels, you should have studied Marriott Hotels inside out, balance sheets, nature of business, where they have properties. You should have gone to the Delhi properties. At least one property had had a beer or something like that. Or maybe I shouldn't tell you to drink in the class, but I'm just saying, just go hang out or something like that, have a dinner at a Marriott property. The point I'm trying to emphasize is that when you're going for an interview, you should be completely immersed in the company. You should be so knowledgeable that they will be blown away by your knowledge of the company, okay, and the nature of the business. That should be your goal. But a lot of times I'm finding people, you're not doing enough work, okay, in terms of your background study and all that. Okay, so that is just a little recap. Okay, so I don't know how I got into this lecture, where I was when I got into this lecture, but we'll find out. Okay, where were we? I was talking about, what was I saying? We discussed the Australian dollar loan. Anyway, I don't know. I got confused somehow. I was talking about something else, and then I got into this lecture because I'm concerned about this. That I don't know if prayer ratings is coming this year, but if you guys go, I want to make sure that everybody is thoroughly prepared, so that we can score more. More of our students can get placed. Okay, that is basically. I mean, there's a reasonably good company, so. Check with Manik sir, find out, and Manik sir can also give you very good tips for DSCR and all that I was talking about, debt service coverage ratio. Please, be clear about your financial statement analysis and your ratio analysis. That stuff should be like, doing WhatsApp for you guys. Okay, should be very, very fluent, and all that comes with practice. Okay. This is all from practice. I remember when Dina got her job, she was asking me that, so she was saying that, sometimes I'm not very fluent and all. So then I told her, there's basically no need to be worried about. She was a little nervous. But I said, no need to worry because it's all practice. It's not coming. Sometimes it's a little slow because you have not practiced enough. You keep on practicing, and then after 6 months, you'll be even more fluent. So everything is practice. Okay. So remember that. So it's not going to become fluent in one night. So you have to keep on pegging away, practicing regularly, and then eventually it will become very, very easy for you. Okay, so all that lecture is done. So you saw that AA is right about the position. Okay. Now, last key risk factor, we showed you why when we discussed about Srishti's observation that there is a sixth KRF, which is because of the floating rate indexing on the US dollar loan. The US dollar loan doesn't create any currency risk because payable is in liabilities in US dollars, your revenues and assets, therefore your assets are also in US dollars. So no FX risk, but sure, there is interest rate risk because the index is floating. Okay, and you saw a picture of how dramatically dollar LIBOR can move. Okay, so in this case, what happens? If you remember your floating rate, this is the note we had. So now we come back to the discussion of the last underlying position, which is the dollar loan. Okay, the KRF market in this case, as she has correctly identified, the dollar loan is at a floating rate LIBOR, and the chart is let's pull up the chart. It'll be nicer to look at it. Fred will find it. I think we have it here. We can actually launch it from here. This is global rates, and somewhere here, ICE LIBOR. That's right. Okay, there we have our chart. That's what we want. Okay, so we can launch it from here. I don't have to go through the other links. All right, so let's look at this. So now the question is, we have finished the discussion of all the other positions, underlying positions. We identified the KRF markets, the KRFs, and for each KRF market, we identified the underlying positions. Why are we doing this? Because in order to run our hedging program, we need to be clear about these things. We need to know the clear answers. We need to be clear about the answers to these things, because that knowledge is going to help us when we are running the hedging program. In this project, we'll be running the hedging program for this company. So therefore, you have to know this. Okay, now let's look at this. Let's look at Max. I like to look at long-term data. Okay, so there we are, 3-month LIBOR. Now, we know that in this KRF market, okay, this is one of the KRF markets because the US dollar loan is indexed to floating rates. It's a 3-month US dollar based loan, and the loan is for longer than 3 months. Okay, so essentially you have a 5-year loan, and the rate is being determined every 3 months. So there is interest rate risk because you do not know what the settings will be on the future maturities. Okay, this is where I think when we do a cell shifting down, going to cross it and see what. Yeah, okay. So we have the full loan is for let's say 5 years, but the interest rate reset is happening every 3 months. So we only know the reset, only know the actual interest rate for the first 3 months, and the balance we don't know. It could be very high, it could be very low, and as you can see from this chart here, it has shifted. It has flipped around quite a lot. Okay, so therefore that's our concern. So we know this as a key risk factor, 3-month US dollar LIBOR. So now my question is, with respect to 3-month US dollar LIBOR, how should we consider our position? What should we consider to be our underlying position? Should be quite easy. Let's ask somebody. Let's find out who else is sleeping. Okay, let's ask Shubham. Shubham is sleeping. Shubham is very concerned about attendance marking. So Shubham will give me an F for my marking of attendance because I'm not doing a good job on it. Okay, but Shubham is sleeping. So 1 minute. Okay, so who else can we ask? Let's ask Gagan. Yes, Gagan. Gagan is also sleeping. Okay. Let's Vipul has raised his hand. What is the underlying position, Vipul?
That is short according to me, sir.
Vipul is saying short, and Shrishti, what is she saying?
Sir, can you repeat the question?
Yes, Shrishti's voice is too soft. We can't hear her.
No, sir, there was someone else speaking.
So what is your answer?
Sir, my answer is that position is long.
Position. Shrishti says that position is long, and Vipul says position is short. Okay. So in this case, Vipul is correct. Okay. Sorry, Srishti said it's long and Vipul said it's short. I don't know what I actually said. Vipul said that the position is short, and Srishti said the position is long. So it's actually 1 minute. Let me just. Okay, we closed it. I'll just wrap it up quickly here so that we can go on to a new topic the other day. 1 minute. Just give me a second. Okay. I'll just let you go in a few minutes. Okay. All right. Okay. So the answer is Vipul is correct because what happens is very simple to understand why. Because again, if you see, you are paying a loan indexed to floating rates. Suppose that this is your first reset. Let's take an example. Let's say first reset, the first accrual period, the interest rate is set over here. And let's say just to show you dramatic changes, the second accrual period when it comes to setting the next rate, that is when it comes from 3 months starting point to 6 months at this point, next 3 months accrual period is going to be set. At that time, let's assume the rate has gone to here. Okay. So you have gone from rates from about 5.86 or something like that to 10. So obviously now for the next maturity, you're paying 10. For the next accrual period, you're paying 10. Here you started out by paying 6. Now you're paying 10. Now who knows what you're going to pay here? Maybe it'll go to 12. So now suddenly your interest rate, this one you paid 6 and here you're paying 10 and 12. So rates are going up. So now obviously greater outflows are happening because of interest payment, interest liability. So you're essentially, it is the equivalent of losing money. Okay. So as the market goes up, you lose money. As the market goes down, you make money because your payables on the floating rate loan are less. So therefore, in this KRF market, your position is short. Okay. With respect to this KRF market, which is 3-month euro dollars, your position is short because as the rate goes up, market goes up, you lose money, and the market goes down, you make money. And a short position behaves like that. Okay. So that completes our discussion on underlying positions. In the next case, we'll go then we'll go into the decision problems and how you actually manage the hedging program. Okay. All right. Okay. So any questions? Any conceptual questions? And then I have I will just ask. I will try to organize. I'll just tell everybody here. Okay. Anybody? Let me just please stay on for one more minute. Okay. What is the time here? Okay, I'm taking 2.5 minutes extra, so I'll take 3 minutes. Okay. Anybody has any conceptual question? Okay, I'll tell you what. You have 2 CRs here, right? You have Utsav and Siddharth. I will organize a session for. I'll just take a few days to do it because I'm a little bit busy. But I think there are some clarifications. I will organize a tutorial session where I will discuss the question papers for both IPM and FDRM. Okay, that session will be only to discuss. I mean, not just only, but mainly to discuss the question paper. I'll discuss the 2 question papers. So Siddharth and Utsav can get it. I will get in touch with you later as to when to do it, or you just remind me. Maybe we should set a time. Let me see where we set it. Today's January. I'm a little bit busy till here. Let's try to set it somewhere next week. Maybe not next week, actually. It's a little bit. Okay. So let's try to set it till early Feb or something like that, if we can. Let's try to set it. Mukul and Srishti, will it be okay for you? Will that be too late for you guys? Because you had specifically asked about the question paper. Is that okay for you guys if we do it in first week Feb?
Yes, sir.
Mukul?
Yes, sir.
Where's Mukul? Okay. It's okay. He can sleep now because the class is over, although I have not dismissed you. So anyway, all right. So let's do that. So these are not conceptual questions. So I will, let's try. So why don't you just get in touch with me, Utsav and Siddharth, one of you to figure out the exact time for that. Preferably sometime late in the night, maybe 10:30 type is suitable for me. Okay. And we'll organize a tutorial session which will discuss the 2 question papers. Or whoever wants to attend, I'll send the link and everybody can, whoever wants to attend can come. And you guys can figure out what is convenient for the batch and let me know the time. Okay. All right. Utsav, you're there, right?
Yes, sir.
Okay. Figure that out. You discuss it between yourselves. Let's shoot for first week Feb somewhere. Okay. Then because I'm at a little tied up till the end of the month. Okay, so I think that will be better somewhere in the middle. There is a day when we have Wednesday night, you guys have a class. So Wednesday morning you have a class. So I would like to do it on Wednesday night type, or maybe approximately 3rd Feb or something like that. Let's shoot for that. Okay. All right. That's an administrative job. Any conceptual questions at this stage? Okay, fine. So we'll stop it here. So we'll organize that tutorial and then we'll try to organize more tutorials. If anybody needs, we can organize more of them. Okay, so let's first at least go for the question paper answering part of it. Okay, so I'm stopping the recording here. No more questions.